All right, and officially we are live. Good morning, everybody. Welcome to Money Matters, broadcasting live only on onedealaway.com/live. My name is Neb. This is Money Matters, and today, in today's episode, we have actually quite a bit of news and excellent content, if I may say so myself. We're going to be looking at some news as to what's going on inside the Germany and how the coronavirus is affecting them. We're going to be talking a bit more about Saudi Aramco and what's going on in the oil market. We are going to be discussing gold and yield rates and what's going on in that side of the world as well as where is the gold going. We just received news, or maybe not just, but it's pretty new and pretty relevant. That news is coming out that basically is talking about the fact that many people are taking gold out of Hong Kong, and my question is, where the heck is it going, right? So anyways, as you can tell, we will have quite a bit of news that we're going to be talking about, as well as discussing the record numbers of U.S. citizens that are actually leaving the United States, both figuratively and literally speaking. So all kinds of news to be talking about, and you definitely want to stay tuned if you are interested in ways to discuss of how money works, how to make more of it, and how to potentially preserve it. So let's do this. And good morning, good morning, good morning. Today is, I don't know what today is. I have to look it up. Today's Tuesday, August 11th. So happy August. We are halfway to September and school starts. Maybe. I don't know. We're not quite sure if the schools are going to start. I mean, yes, people are saying it will. People are saying it won't. It will be online. It won't be online. It will be sort of in person, kind of hybrid. Nobody really knows what exactly is going to be happening. And interestingly enough, we actually have some reports and news and beliefs and kind of what's going on and how long can we expect this whole coronavirus uncertainty to continue. And it's very interesting. I'm not necessarily hearing as much about it here in United States, but I am hearing quite a bit about it from Europe, from my friends in Europe, yes, and family members, of course, as well. So it sounds like over in Europe, there are conversations basically expecting that this uncertainty will continue for another roughly 6 months, all the way to up to 2 years. So at least up until at some point winter of 21, maybe early spring, up to maybe summer of 22. So we are in for a very, very, very long ride. And if you are struggling right now, perhaps it's time to come to a peace with what's going on. Find your center. Find your way to meditate. Be okay. If you need to get a therapist or whatever, I highly recommend doing that. Get into the meditation, yoga, that kind of stuff. But, finding comfort in the discomfort is going to be the thing for at least next 6, maybe as long as 48 months. Oh, no, not 48. Sorry, 24. Do not panic. Okay, so here it is, a news coming in out of Germany, and they're saying, it's going to stick around for a while. A survey data published on Monday shows that businesses are expecting the pandemic-related measures to remain another 8.5 months on average. Those working in the leisure sector are expecting the restrictions to last for another 13 months. And now you're thinking, well, where did you hear in F24 months? Well, I don't have a report out of here that's a conjectural or whatever, the sort of a hearsay story that I have received from family and friends over in Europe, that there are many European countries and experts that are calling that this is going to continue for at least summer of 22. So that's kind of where I'm getting that information from, in case you're wondering where that is coming from. While some companies are more optimistic, none of them foresee an end to the restrictions for another half year. So they're basically saying at least 6 months, y'all, at least 6 months. Germany went into lockdown at the end of March with tough pandemic restrictions halting most economic activities. Similar happened in the United States and around the world. Country began cautiously lifting the measures in May. True for us as well here in US. And the economy started bouncing back. Yes, however, the health authorities have recently warned about the rise in new daily infections, which we have seen here, sparking a second wave of the virus, as well as the potential lockdowns. And we're seeing restrictions being added now back to the states, and the travel and the quarantine. And if you go here, you got to quarantine for 2 weeks. And if you go there, you got to quarantine for 2 weeks. So if you're wanting to take a vacation in a state that maybe you're interested in, or maybe a country, if you're going to Europe, which, you know, as a US citizen, most countries won't even take you, then you know, you have to plan for 2 weeks to quarantine, then maybe a week of actually traveling and doing stuff. Then when you come back, you got to quarantine for another 2 weeks. So you're looking at about 4 to 5 week vacation, which in the United States, an average employee has about 10 days. So nobody's going anywhere. That's basically bottom line. And even in Europe, when you have a month worth of vacation, right, 30 days, that's 4 weeks, you know. So 4 weeks in quarantine plus maybe 2 days of vacation. Again, nobody's traveling anywhere. Nobody's doing much of anything. And now we've also seen the news seen the news this morning. Definitely feel free to fact check me and research it on your own. But the Trump is basically saying, hey, if you're positive with COVID, I don't care that you're a citizen. You can't come back home. So yeah, no love lost there. Not only can you not just travel to other countries, now apparently you can't even come back home. Before it was you have to travel through a specific airport, but now it doesn't really matter what airport you're using. You can't actually get anywhere, period. End of conversation. So there you go. Something very interesting for you to think about if you want to travel. The coronavirus outbreak has caused record plunges in GDP in most EU countries. Europe's largest economy, Germany, was not spared from economic fallout of the pandemic, shrinking by 10.1% during the second quarter, the worst drop since quarterly GDP calculations began in 1970. So this is very similar to what we're seeing happening in US. I mean, for crying out loud, I think we're the world leader in the GDP drop. What do we go down? You know, 40%, whatever it was. It's astronomical number, absolutely astronomical number. But talking about astronomical numbers, this is nothing in comparison to what we're seeing happening in the oil industry. That's right. Remember in April, the prices of oil went negative, right? So you could buy a barrel and get paid for it handsomely and still get the oil, right? And you actually had to take a possession, so you couldn't just like walk away, which storage was an issue. And large storage facilities, large tankers that could store oil actually saw a nice increase and boost to their income. So congrats to those that saw it coming and made money. But Saudi Aramco, arguably the largest company, is seeing profits crash 73%. Ouch. That hurts a lot. World's biggest oil exporter, Saudi Aramco, has reported massive losses in the second quarter, with its net profit nosediving 73.4%. Oil giant's net profit plunged to 24.6 billion reals, or 6.6 billion US dollars for 3 months to June 30th. So that's a very, very big drop if you really think about it. And of course, this has impact on not just the production and the income, but also those that are trading the darn thing on the open markets. Strong headwinds from reduced demand and lower prices are reflected in our second quarter results. We're seeing a partial recovery in the energy market as countries around the world take steps to ease restrictions and reboot their economies, but we just talked about the fact that they are starting to shrink and close back down, and people can't travel and won't travel. They're not going anywhere. So a little bit of a boost of what they're hoping they're going to get. Not so much. So if you're in the oil and the natural gas and that kind of stuff, perhaps it's time to rethink. I don't know. Not a financial advice, but just sort of news to give you information to kind of think through things on your own. Fair? Okay. Now, notably, the company's shares fell much less this year than those of its overseas peers, while Saudi Aramco stock slipped around 6%, which is nothing if you think about it. Their profits have gone down, what, 73.4%? They might as well call it 73.5%. ExxonMobil down 38% stock prices, and Shell is down 50%. So, yeah, there's definitely lower prices, lower things happening right there. Now, while crude prices have already bounced from April lows, thanks to the output cut agreed on by OPEC and other producers, they're still down around 30% from a year ago. Saudi Aramco went public last year with its IPO becoming the largest in history, and the oil giant has long held the position of world's most valuable company. That is until last week when air went the wrong pipe. Until last week when it was dethroned by a US giant, Apple. So there we go. Apple is now seen as the world's most valuable company. However, there are some news about Apple potentially suffering the sales in China if WeChat indeed gets banned. So you definitely want to be on the lookout for that and see what the impact might be. It's very interesting to kind of see that while the output, everybody has agreed on the output, the prices are still down, all of that stuff. But, there is more stuff going on. More pain is coming, as everything is indicating. We're going to look at some additional news to kind of discuss that piece. One of the pieces that I did want to share with you is that you might have heard about it, but you know how, and we actually used it here on the channel as well, and talked about the fact that the Robinhood app, the Robin stats or shares or snacks or whatever, Robin something, it was a black site with instead of green, the Robinhood, the green feather with the little arrow up. It looked like a little bird, like a robin, right? And it was a fuchsia color, fuchsia pink, or I guess just fuchsia. I don't know why fuchsia pink, just fuchsia. Fuchsia color thing. Apparently it's going away, and now Robinhood is going to, well, it's not going away. The data and everything is going to stay, but you're not going to be able to get it for free anymore. So that part is going away. It is going to be sold now. So now even the company is saying, yep, we have your data and we are selling it to the highest bidder. And of course, everybody then gets to front run your options or stocks or ETFs or bonds or whatever it is that you are getting through Robinhood. And so there you go. That's kind of what their model is. Steal from the users and then sell it to the highest bidder, allowing them to front run your trades and make more money, while who knows what happens to you. For me, that's the reason why I enjoy cryptocurrencies and going into it, because I feel like I get to front run the institutions. You get in early, you sit in tight, you accumulate along the way, and as institutions go in, and we talked about some of the institutions kind of jumping in, you basically get to front run them, and that is a very exciting piece for me. Now, here we have a bit of news from Hong Kong. And you've likely heard that there is all these problems and trouble happening in Hong Kong with the China kind of taking over, going back on the deal, reneging it, and saying, yeah, we agreed to something, but you know what, forget it, we're not doing it. Again, yet another proof the governments can do whatever the heck they want, including prohibiting citizens from entering back, taking away your rights, locking you down, not allowing you to travel, not allowing you to do things, nagging down on the laws, changing the laws, increasing the property taxes, decreasing the payroll, whatever, right? They do have a right to repossess your gold if they want to. They do have a right to shut down the internet if they want to take the crypto. So they can do whatever they want, which basically lets me know, hey, you might as well just do whatever you want, of course, within legal and ethical and moral standards. Let's go with that as the basic minimums. And, and then just sort of play along and watch on the news. Stay tuned in to Money Matters to kind of learn how do you protect and what's happening. So here's what's happening in China or Hong Kong. Let me be more correct. And wealthy are taking out their gold holdings out of town. It is reported that the rich people of Hong Kong took their gold out of the city for fear of security. A law drafted for Hong Kong in China last month. Financial Times reported that about 10% of the gold assets and private investors have moved outside of Hong Kong in the past 12 months due to the expectation that China will tighten security measures and potentially take their gold. So where are they taking it? Well, Singapore and Switzerland are the most alternative destinations. What? Not sending it to US? Really? Why not? We are so friendly to everything. No. Yeah, a little bit of sarcasm here. My apologies for those that don't enjoy it. But anyways, as you can see, folks are taking the gold out of Hong Kong, putting it in places where they feel that the laws are a bit better to protect you. This further drives down the importance of cryptocurrencies, potentially Bitcoin, where it's going to be even easier to move it, because now you got to think about it, right? If you are in a physical gold, and potentially, arguably, you should be if you are not just trading, although I don't know, you might be trading it alone. Just keep in mind that what you're trading are the ETFs. It is not, it is sort of backed by the physical. It's just that, the physical to paper version of it is like 100-to-1 ratio. So there's like 100 contracts, if not more. Please fact check me on that. But let's assume that it's 100 contracts all claiming the same ounce of gold. I don't know how they're going to make that work, because last time I checked, you can't multiply the darn thing. The alchemy still does not work as much as people might try. And COMEX and London-based LBMA, London-based something. Let me know in the chat. Let me know in the comments. And talking of the chat and the comments, oh my gosh, I totally forgot to do this. I want to welcome everybody watching this live. Hello. Please feel free to say hello. We're going to do a Q&A at the end as always. And welcome to everybody watching on YouTube. Do me a favor, smash that like button right now. Let's help people find the channel and help them along the way as well. And of course, feel free to subscribe if you're interested in learning about money, wealth. When we talk about the gold, we talk about real estate, we talk about cryptos. So we talk about all kinds of different news that are happening inside the business, the finance, the markets, investing, all kinds of stuff. So we do a lot of alternative stuff as well. So we don't just focus on the markets that everybody else talks about, but we do touch on them because it is important to see where the majority of the money is living and where that money potentially is moving and going to. So now that we talked about that piece, so anyways, they do have 100-to-1. So if you're expecting that ETF or that derivative that you just put money in is going to actually give you the gold, they won't, because they just can't. They don't have enough. So then if you're holding a physical, now you got to think about where do you store it and how do you move it from a storage here to a storage in, I don't know, Singapore, right? Like that's very expensive. That's very, very costly. And, we're not talking about people that have like a gram or like, a fifth of an ounce or something like, or a tenth of an ounce or whatever, right? We're talking about people who actually have some serious wealth that they are storing inside these bars and coins and that kind of stuff. So it costs a little bit of money to move that stuff and travel. And if you're thinking, well, I'm just going to put it in my pockets, you can't do that either, because most countries have laws about how much money whether it's a currency like paper currency in dollars, yen, euros, that kind of stuff, or if it's even gold and that kind of stuff, of how much you can transfer out of the country. So this is the part where it's kind of nice to have some of the physical, but it's very limiting. And then you have something like a cryptocurrency that your wallet lives somewhere online, or maybe it's a cold storage somewhere that you can carry with you. And simple memorization of 12 keywords opens the gates and your wealth, and it's absolutely amazing, right? So that's just a case for the whole thing. And it's much easier to transfer, it's much more portable, and so on and so on. Talking about the fact that folks are not going into the US and putting the money there, we do have some reports about the greatest number ever of individuals actually denouncing their citizenship here in United States. Ouch. So Americans give up citizenship in record-smashing numbers as expats find pandemic and political climate too much to bear. And this is telling it all of burning of the passport. So this is very, very sad and disturbing news. And I don't know how you feel about the whole thing. Let me know. Americans are ditching their U.S. citizenship in droves thanks to an unbearable political atmosphere and the ongoing COVID-19 crisis, new research shows. More than 5,800 Americans renounced their citizenship in the first half of 2020, which is a dramatic 1,210% spike compared to the last 6 months in 2019. And they're seeing number of folks that are just, leaving and are saying, I don't think so. The surge in those abandoning their citizenship, particularly among the estimated 9 million Americans living abroad, has been especially driven by ever more burdensome tax rules. So they're basically saying that this is silly, we're not doing it. It's regardless of where you live. So I think most people know this, but in case you don't, regardless of where you live, regardless of how you make your money, if you're a U.S. citizen, you're required to pay U.S. taxes. So we are definitely turning into not so land of the free, home of the brave country that we used to be at one point. There's a lot of freedoms that are taken away, mostly by the measures of safety. And that kind of brings me back to, was it Benjamin Franklin who said those are something along the lines of, those that are willing to trade their freedom for a bit of safety shall receive not safety nor freedom. And unfortunately, we are not listening to our forefathers when they say such a thing. But nonetheless, we are doing it. And so now we're seeing a mass exodus. Well, not mass exodus, but 1,200% increase in exodus. In order to denounce or basically say, what, I am no longer a citizen of United States, you got to pay about $2,500 fee, $2,350 to be exact. And people are paying and saying, what, take that, but I'm keeping my taxes. Now, and again, when we talk about taxes, I don't know how you feel about the whole thing. I'm not crazy about paying the taxes, but I look at the vast majority of the countries, and Europe is all over the map with the taxes, on the lower end, ranging about 40 to 60% about average. And then we have places where it's about 80% of your income is taxes. But on the other hand, when you get sick over there, they still have excellent health care, and you're not going to have to mortgage the neighbor's house in addition to your own just to survive a broken arm. So, something to consider. I mean, simple transport to an ER and, is going to set you apart from, you could buy a freaking new truck for the amount of money that it costs to transport you to ER, and that little band-aid that I put on you is going to be a few $100, whereas you can buy a whole box for what, $5, something like that. So anyways, definitely a lot of interesting things to talk about and discuss, but a lot of that stuff is likely politicking, and we're not going to do that. Even as an unprecedented number of Americans leave their citizenship behind, new immigrants are seeing major spike in application fees, some of which rocketed by more than 80% earlier this month. Under the revised fee, new applicants will pay some $520 more than before, erecting a larger financial barrier to arrivals, for whom a number of fee waivers were also recently eliminated. What does this basically mean? It might not mean like a big deal to you right now, but basically what this means is that more people are leaving the US, the birth rate is actually down, and not enough people are immigrating into the country because of the laws, because of the fees. So what that means is that we are rapidly getting an aging population, and our demographics are starting to look horrific. What has helped us going here in United States, and this has nothing to do with the politics, it just has to do with pure logic and numbers. What has largely helped us going is the immigration, the ability to get more people in who are younger, who are of working age, that can actually be productive members of the society, so that we can pay into all of those taxes and liabilities and stuff to support our elderly as they age out of the workforce and as they go into the retirement and need some help and support. This is the largest number of people that we have. The boomers are going there. We're all aging, and without enough younger people to support it, we are in deep, deep trouble. And so this is very problematic when I read it from this perspective that says, economically speaking, US might be heading into some troublesome times. And of course, there is a conversation that maybe robots and AI and that kind of stuff could potentially help us. But again, we still need people to operate and run those things. And so now, of course, short term, we're struggling with having jobs. Long term, this is going to be even more problematic, and we are going to see probably potentially some troublesome times. What this kind of brings me in to talk about is the new executive order. Remember, we talked about it yesterday and day before yesterday, and you likely heard the news over the weekend that Trump has signed a few different executive orders. One of those is the executive order on the tax deferral of the payroll tax. So here is, what does this mean and what can you expect? Workers shouldn't be waiting for a windfall in their upcoming paychecks. The order might not bump and uptake home money all that much per paycheck, and that's assuming employers even pause the tax withholding from September 1 to the end of the year as the order instructs. The order defers the employee's obligation to pay 6.2% Social Security tax per paycheck, which makes less than, and that applies for those that make less than $4,000 every 2 weeks, roughly making it $104,000 a year. The order instructs the Treasury Department to look into how the government can forgive deferred tax payment, but for now, the tax obligation isn't being forgiven. So basically, it just defers the thing, but it doesn't know how to actually to forgive it. It just says, hey, Treasury, you over there, you go and figure out how we're going to do this stuff. I just came up with this brilliant idea, and now you go and figure it out. And one of the interesting things in my 20-some years of working and dealing with some of these highly bureaucratic components and stuff, you oftentimes have the people on the top that kind of come up with the decision saying, this is a brilliant idea, go and do it, and then says, okay, people, you go out there and you make this happen. You out there, it's your job, you got to go do this. And then the person out there is like, that's not possible, you can't make this happen, and here's why, and here's all of these problems, here's all of the trickle down and all of these challenges that are kind of coming in. So it's very, very interesting to see this stuff. It is not clear whether employers are going to pass the savings on to the employees. I personally argue they likely won't, But then again, you have your own opinion, and I will share with you exactly why, because it was here written in this article, and I agree with them. Payroll taxes consist of Social Security taxes and Medicare taxes. Every pay period, an employee pays 6.2% for Social Security and 1.45% for Medicare. Workers pay the 6.2 Social Security tax on annual earnings of up to $137,700. After that, not so much, right? The employers pay the same rate per paycheck, adding to a combined 12.4% for Social Security and then 2.9% for Medicare. Now, this goes in, and then this money is used to pay out the elderly, the disabled, those folks that actually need to get some help. Makes sense, right? The new executive order puts workers' 6.2% obligation on hold. So, in 2008, median income was $63,179. We're going to assume that they rounded up to $64,000 for ease of math, to use an example. You take that, you divide it into 26 paychecks, which is basically that biweekly pay, and it comes out to roughly $24.61 per paycheck pre-tax. So $2,461 per paycheck every 2 weeks. The 6.2% Social Security tax of that paycheck would be approximately $152. And then you have 2 paychecks per month, and you have September through the end of the year. So you have September, October, November, December, 4 months. That comes to a deferred amount of about $1,220. We've seen this number before. Oh, yeah. That's that $1,200 paycheck stimulus thing that they were sending us and talking about. And that's kind of what it accounts to. But here is kind of how the whole thing works. Freezing the payment of employee Social Security taxes from September to the end of the year would result in $139.5 billion not going to the government coffers. And of course, this number assumes the 137,000 as opposed to 104,000. So instead of 139 billion less, maybe it's I don't know, 135 billion, 37 billion, something like that. So a little bit less amount than what is being shared over here. Now, the payroll taxes, here's the part that is interesting. Yesterday I talked about the whole Social Security and Medicare and that kind of stuff is going to evaporate anyways, unless the new executive order laws and that kind of stuff are rolled into the effect, because we're spending more than we are bringing in. The payroll taxes brought in $914 billion for Social Security during the fiscal year of 2019. I need you to remember $914 billion. This is coming Congressional Budget Office. But then I was like, well, how much is it being paid out? I couldn't find it for 2019, but what I did find, let me make this bigger so that you can actually see it, so it's not like Nev is making stuff up. The U.S. federal government spends in excess of $4 trillion a year, and the top of the heap is Social Security. This was this is information from 2017, so 2-year gap. Now, they racked up $952 billion in expenditures in 2017. So, $952.5 billion is spent in 2017, so we can account that that is much higher for 2019, but let's assume that it stayed the same, that the number of retirees didn't go up, which it did, because remember the boomers, they are retiring and in higher numbers every single year, and I believe 2020 is going to be the highest number thus far, where more people are going to say, you know what, bunk this, I am done working, I do not want to risk my life, forget it, I am out of the employment piece, or simply they were let go, or they're taking earlier retirement like my mom did in the hopes to preserve some of the younger staff members, team members that she had on her team. So, there you go. But anyways, let's assume that it is spending only $952.5 billion, and remember we collected $914 billion, so that means that we are short what? $40 billion? No big deal. Yeah. So anyways, that's the reason why I'm saying it's not going to be there anyhow. So, pay it, don't pay it, it doesn't really matter. We are short on that stuff and we're going to run out sooner rather than later. And I think even they are saying, yeah, we're running out of money. Unless there's a law changing the situation, the taxes are due at the beginning of next year. Employers will be reluctant to pass along the deferred taxes to their employees because they may have to figure out how to recoup those funds when they make the deferral payment. And I agree, you're not gonna send it out there, and give it to Joe, who may or may not hold on to it, who might go and spend it, because how the heck do you collect the money then afterwards? So they're likely going to hold on to that money, wait to see what happens to the law, and then maybe potentially in about, I don't know, 5, maybe 6 months, you might get that money when they figure out if they have to pay it or not. And that is going to be a huge blow to the business, because now they're going to be holding on to the money, but they can't spend it, they can't send it out there, they can't do anything, the intelligent businesses. And then the problem is going to be those that are use it in the operation or end up spending it and stuff. Now when they have to go pay you back, now we're going to see bigger issues for those businesses happening. So again, sounds lovely, but a lot of problems could come out of the whole thing. It is highly questionable whether the firms would actually pass the money along to their workers because of the business, because it is the business the one that is on the hook for the taxes, right? And if the business did pay the tax withholding funding along, it is doubtful that some will, but most households would not spend it. They would likely hold on to it because, later down the line in 4 months, I'm going to have to pay this. So even if you give me extra money, I'm holding on to it because I got to pay it. Now, some may not necessarily think that far in the future. They might end up spending it, which then causes problems down the line. And final bit of news that I promised we're going to talk about has to do with the bonds and the real yield rates and what's happening there and how is that affecting some of the things. So things for you to consider and think into the future, not just for today. Here is how record negative yields are driving a recorded rally in stocks, golds, and everything else. Real yield hits a record low of negative 1.1%. We've been talking about the fact that it's going negative and it's going more and more, and now it's hitting it even harder. This is cute. I like it. Look at this. Like this? I like it. All right. Deeply negative yield rates, bond yields, after accounting for inflation, are driving gains in all corners of financial markets. The 10-year yield stood at around negative 1.05%, derived from trading in Treasury inflation-protected securities. It hit its record low of negative 1.1 on Thursday. And of course, you know that the bond prices are inverse. So as yields go down, the prices go up. Sounds silly, but it's true. By definition, the nominal bond yield is equal to inflation expectation plus the real yield. The combination of higher price prospect but quiet trading in the bond market therefore forces down real yields. Right? So we're going to read this again to learn. By definition, the nominal bond yields, what we're seeing is being posted, right? That 0.57% and that kind of stuff is the nominal bond yield, but it's equal to inflation expectation and the real plus the real yield. So the combination, so what we're seeing is that then it means that if we're at 0.5, right? And if the real yield is negative 1, okay? That means that the inflation expectation is about 0.5%. There you go. That's kind of the math combination, breaking that thing down. The combination of higher price prospect but quiet trading in the bond market therefore forces down real yields, right? So because nobody's buying and that kind of stuff, that's what's driving the real yield lower, which potentially may or may not affect the nominal yield, which is then the expectation of what might be happening. Oh no, we're frozen. Hold on. Sorry about the interruption and the freezing. So the combination of the prices, so basically is meaning that if the nominal yield is staying and the real yield is dropping, that means that the inflation perspective is on the uprise. Okay, now when the money is being printed, it has to go somewhere, right? So investors have traditionally understood that the real yield is one of the most important gauges of financial valuation, because of lower risk-free interest rates makes all other assets more inviting by comparison, right? Because if you put something in a lower risk but it's not yielding much of anything, you then start chasing yield, which means that you potentially could be chasing higher risk. And then people get into all kinds of stuff. So they'll get into the equities, they get into the options, ETFs, mutual funds, futures, derivatives, derivatives of the derivatives, and all kinds of other things. People are getting now into all of that stuff. They're using leverage to be able to invest. They are using ability to get into cryptocurrencies. And if you're looking for something that has a yes, it's relatively speaking high risk. It's definitely higher than treasuries, so to speak, potentially, maybe, I don't know, because it depends of what you count as a risk. Because if you're expecting that the US dollar is going to crash, then treasuries might be a very high risk, as well as the US dollar cash, right? If you expect that the US dollar is going to remain, it might change kind of how it goes, then it's a super low risk, right? And it has a potential of doing really well, but the yield may be horrible, right? Then you can go in and look at something like cryptocurrencies, where you do have a risk of a total failure and losing money and that kind of stuff. But on the upside, the return for that risk is probably 100-fold than what the risk is. So then you have the risk return sort of thinking and consideration to say, would it make sense? Now, would I bet the farm on the whole thing? Probably not. But would I put in a portion of it? Absolutely. Am I doing it? Absolutely. Another way that you can kind of hedge with that whole risk is within the gold. Again, does it have a potential that it's going to go down to zero? Sure. Is it very likely? Probably not, at least not right now. Is there risk? Absolutely. Is there a return to it? Yes. It could actually go to well over $4,000, $5,000, even $10,000. We just don't know that quite yet, and it just depends on the market forces and what's happening, how long the pandemic lasts, what the impact is in the economy, what the market is believing, what the thinking is behind for everybody else. So there's a slew of things of why something might or might not be necessarily coming through and driving, so to speak, of where the prices might go, right? The expectations and that kind of stuff. Then you have another option within it, is that potentially could go with the stocks. I don't know. Stocks are highly overvalued when I look at the economy and stuff, and so there's risk there, but there's some opportunity. So it might be a decent potential. Again, none of the stuff that I'm sharing here is financial advice. It's just my way of sort of thinking and I'm processing out loud. And but I'm not. The stocks are not something that I would want to participate in, and that I am participating in right now. But to each their own. Another one to think about, sort of risk, return, reward, that kind of stuff, is real estate. And as you know, I am very bullish on real estate as a whole, and but not necessarily going in and competing. And I like to get stuff in the off market, utilize it for some passive income, get it at a discount, potentially do some leverage maybe, and definitely if there's inflation expectation, especially high inflation expectations, but there's risk with that as well, because you can get potentially a tenant, if they don't pay, you're not getting that income, you still got to carry the darn thing, and so there's a risk component with that as well. So again, everything has risk reward. You just have to really think through the whole thing and balance things out for what might make sense for you. Okay, so the fall in inflation adjusted interest rates has fanned a broad-based rally in gold, high growth stocks, corporate bonds, and emerging market assets. I would add on cryptocurrencies as well as some of the real estate. I mean, we've been talking about this stuff on this channel here. They're not talking about it there because, traditional news, well, they know stocks, bonds, mutual funds, ETFs. That's it. That's as far as they go, and occasionally gold when it starts to spike. Lower real yields have also powered the dollar's decline as assets of other currencies become more attractive. The greenback is down 3% year to date, based on the trading on in the ICE US dollar index, the XY. The dollar is a world's reserve currency, but also a store of value. When that value moves down, you start to look for other places for value. But some warning signs. Some warn the slide in real yields is leading to crowded position in asset benefiting from an expectation that interest rates will remain low for a protracted period of time, creating the risk of a vicious whiplash if real yields do turn higher. And there is a potential that they could. There's a very good potential that they could. We will see of how that is going to play out. There's also a potential when we're talking about the dollar being the world reserve currency. It is, but what does that actually mean? We could see it's oversold. Dollar is oversold right now, and the intelligent investor in me says you buy things when they're undervalued, and you sell them when they're overvalued. So, when they're overbought, you kind of hold on and let it accumulate and kind of let it go down. And, just this morning, I've seen that the gold dipped below $2,000, which was something that I kind of expected it to happen. How long will it go? I don't know. Probably not super, super low, but it will go down. It will correct before it takes on another rally. And the same thing holds true for a dollar. It could potentially spike up, so it might not be completely out of the race quite yet. And there are some other prominent economists and macro investors and analysts that will agree with me on this one. If these levered traders are forced to dump, and we're talking now about the big levered traders that are using the algorithms, computers, and leverage to trade. So if these levered traders are forced to dump their holdings to avoid taking on heavy losses, the reversal could amplify a sell-off in gold, tech stocks, and longer dated treasuries. Expectation is that the central bank will step in with the large-scale asset purchases, and they have been and likely they will. However, we just don't know for a fact. So there you go. This is the news today. This is what we had to cover. Thank you very much for watching. If you are watching this live, stay tuned in for Q&A because we're going to do that in just a moment. For everybody watching this on YouTube, thank you for watching. Do subscribe to the channel. Do join us live if you can tomorrow at 7 a.m. And until then, stay forever money blessed. Do remember, you are only one deal away.